We are now joined on the show by David Blitzer, who's Managing Director and Chairman of the Index Committee at S&P Dow Jones Indices. He joins us on the show from London. Now, David, to begin with, after last week's Fed action, what do you expect the near-term impact on emerging market equities is going to be?
I think the impact is positive both on the emerging markets and also on markets around the world, including here in Europe as well as back home in the United States. It probably is not quite as large as some people had hoped. The QE3 action has widely previewed back in the end of August by the Fed chairman, and as a result it was somewhat a case of buying the rumors and then selling the news.
You know, David, contrary to earlier expectations of a huge gush of liquidity post-QE3 to emerging markets, the picture this time round is seeming quite different. What would you put this down to?
Part of it is this is the third round, coming very much close in the heels of the second round. And unfortunately, each additional round, unless you really raise the bar of what you're going to do incredibly, is going to have a little less impact. Secondly, I think part of the impact is just the idea that the Fed is committed over the long haul, and that's also a long-term impact. So while we didn't get a big bang at the beginning, I think we'll get lasting results, and we'll see the equity markets have a solid level of support underneath them given to them by the U.S. Fed.
You know, there's been this increasing correlation coefficient between European equities and Asian equities in recent months. Would you attribute this correlation of Asian equities away from, the U.S. to the fact that news flow is today essentially being driven out of Europe?
The global news flow is increasingly the European financial crisis, what's going to happen, will the euro survive, and that kind of thing. And that definitely gets attention around the world. But in the background, I think some of the other economic and market conditions are changing. Increasing comments that China's growth may be slowing. It's not going to go negative, but it looks like it's going to be 5, 6, 7% instead of 8, 9, 10% next year. That's a concern. And second, an increasing realization that the U.S. economy, as frustrating as we find it, is doing a whole lot better than the European economies, which are pretty much in recession. And that has shifted the balance away from China being the strong suit, Europe having the crisis, the U.S. we're not sure, to China dropping down a little bit and the U.S. maybe creeping up. And so that had definitely changed the market-to-market relations.
Now, David, as promising as emerging market equities may seem over the longer term, what would you say the biggest concerns are among most investors in OECD markets?
As we look around the world, I think in just about any part of the world, things are still a little bit nervous and a little bit shaky, coming out of the financial crisis or stuck in the financial crisis in some spots. And that makes people nervous about markets that are a bit weaker, have less underpinning and support, and are more dependent on either financial sector or more dependent on other countries. And unfortunately, that really spells the emerging markets much more than the U.S., Canada, Australia, or the UK, Germany, France, sort of the very solid economies. So yes, emerging markets are a great idea in the long run, but in the short run, volatility is going to be the word of the day.
David Blitzer, thanks very much for joining us on the show from London with your outlook for the markets, emerging markets in particular.